40 in good shape. Pratik Gupta is Chief Executive Officer and Co-Head at Kotak Institutional Equities. Pratik, good to have you with us here. Thank you very much for your time. You know, we had Jahangir Aziz, JP Morgan, who looks at emerging markets, India, etc., from the economy point of view. And his broad point was that, you know, US and emerging markets are doing just fine. I mean, you're at a point where perhaps you got to ignore what's happening in China and Europe. So he says this country-wise emerging market economies are all raising their country growth forecasts, even with all that is happening around the world. So it seemed to be just fine, Pratik. The problem, though, is valuations, isn't it? How comfortable are you, and what are we really pricing in here now with what the market has done?
Hi, good morning, Prashant. I think you hit the nail on the head. And this is what we are hearing at Kotak from our discussions with global investors as well, that from a top-down perspective, India looks quite attractive. The longer-term outlook is very, very good. There are very few large emerging markets in the world where you can see GDP growth north of 6% for the next 10, 15 years. And the macro outlook is also looking stable, whether it's the current account deficit, the fiscal situation, inflation. Yeah, it's gone up a little bit right now, but hopefully this is a temporary phenomenon and it will come down. So overall, top-down looks fantastic. The problem is bottom-up. So when we speak to our clients globally, they want to invest in India, but when it gets down to stock picking or investing in particular sectors, that's where we run into issues, with most of them complaining that valuations are indeed quite high. If you look at the Nifty, for example, we're now trading at 21 times FY24 PE, about 18 times FY25 PE, for earnings growth of barely about 15% on a price to book basis is about 3 times for about 15% ROE. If you look at India's premium versus other the MSCI EM index, we're now at a premium of about 60%, which is more or less in the middle of the range. It's historically ranged between 40 to 80, 90%. So India's not sort of cheap by any stretch of the imagination. At the same time, the longer-term outlook is very, very attractive still, and we also remain quite positive from a long-term perspective. But the problem is, I think in the short term, we will most likely go through a consolidation phase because of the expensive valuations, both at the broader market level as well as at the individual stocks level. One thing I can tell you is we don't expect a very large correction. We believe there's a lot of money waiting on the sidelines, both foreign money as well as local money. If the market were to correct more than, let's say, 3 to 5%, we think a lot of money will come into the market and support the market. But equally, in the short term, next few months, we don't see a big rally either. So we think, unfortunately, we're going to be stuck in this boring zone, plus minus 4-5% for the rest of this year.
Okay. Well, Pratik, hi, good morning, and thanks for joining in. I just want to point out to our viewers that, you know, this whole electric vehicle, this bunch of stocks continue to rally. So whether it's JBM Auto, just want to get them up on the screen, JBM Auto, there's Electra Green Tech, there's Tata Motors, Ashok Leyland. So the street is clearly very, very excited about the potential of this large scheme for electric vehicle buses across the country. And there's follow-on buying there. Pratik, good morning. So since the market is going to be a bit boring, let's talk about individual sectors, right? Top of mind is this space, I mean, electrification of vehicles. And a lot of people believe that despite the 50-60% rally, this is a structural up move that could go on for years. Are you in that camp as well? And what should investors do here?
Yes, you're right. We agree with the structural story. And I think the more important thing over here is to first look at some of the incumbents. This is actually because of this theme, this risk of disruption for the incumbents. We have been somewhat cautious to depending on the stock, often negative on some of the incumbents in the two-wheeler space in particular, where we think the disruption will be the biggest. But equally, as you rightly pointed out, we think there will be opportunities for the auto ancillaries who are involved with the EV space, and those who have good products, good design technology, good manufacturing capabilities. The only issue over there, however, is in the short term, you may run into 1 or 2 quarters of somewhat weakish demand. The world is slowing down. decision making is getting elongated. And I think more importantly, valuations have gone up again. These stocks are not cheap by any stretch of the imagination anymore. So you'll have to, again, even with these stocks, you've got to have a 3 to 5 year sort of investment horizon to be investing in these stocks right now. But longer term, yes, we agree with the EV theme. We think these are great businesses. But equally also watch out for the disruption risk for the incumbents, some of whom you may see some negative earning surprises over there in the coming quarters.
Hi, Pratik. Good morning. Nigel on this side. Pratik, what about the IT space? How are you all positioned out there? Global economies are likely to slow down in the second half of this year. And there's, some of these numbers are pretty ordinary. But yet some of these stocks are holding up. Maybe, they continue to find preference. How do you approach these stocks? I mean, will it be a place to hide? If you have a longer time horizon, do you think that it's a good time to chip into some of these IT names, or would you stay away?
Nigel, hi. On IT, I think it's still a bit too early in our view. One of the reasons why these stocks have done well is because the US inflation data has come in softer than expected, raising hopes that the US may achieve a soft landing. And frankly, the jury's still out on that. So it's still a bit too early. We are still continuing to see a slowdown in discretionary spending, and especially in IT companies which are focused on the BFSI and the telecom space in particular. We think there is a risk of further earnings downgrades in the coming quarters. And the next 2 quarters, we don't see scope for much earnings upgrades. So over there also, we think given where valuations are, we're going to be range bound. But yes, the longer term outlook on a 3-year kind of view, it still looks attractive. I think the Indian outsourcing story will only continue to improve. And also globally, we are seeing more and more of the cloud migration, a lot of apps being built for that, a lot of software development requirements for that. So that story continues. The other way to play it is also focus more on the large cap IT names, which are less vulnerable to a slowdown in discretionary spending versus the mid caps, where the client concentration risk is a lot higher, where the product, the service lines are not as diverse as you have in the large cap names. And the large caps tend to weather a downturn or slowdown much better. So, and given where valuations are, where some of the mid caps are still trading at par or above the large cap names, our preference would be on the lookout for small corrections, which we expect over the next few months, and buy into the large cap names.
Pratik, you guys are also, Kotak is also one of the largest players on the investment banking side, on ECM, the equity capital market side as well. And the transactions are through the roof. Promoters are selling, private equity is selling, but you've got enough buyers on the other side as well. What's the broad kind of thinking within the team at Kotak? What in terms of how you're looking at all of this activity? The general kind of refrain is, well, insiders seem to be selling, so it can't be good. But I'm assuming it's not really that clean, right? I mean, shades of grey. So tell us.
And you're right. We don't think just because a PE or a promoter is selling, it's necessarily bad news for investors in the long term. There have been numerous instances over the last 5-10 years where promoters or PEs have sold out and the stocks have gone on to do really well. A lot of the IPOs which have come out in the last 2-3 years, they were mainly PE exits, and some of them have done quite well. But I think there is a broader question, and that's a broader concern, and that's what's goes back to our view that the markets will stay range bound. Is this paper supply which is likely to come through both in the form of IPOs as well as blocks? Now that the earnings season is over, when most of these companies and these insiders are out of their quiet period, out of their sort of locked up period, etc., you will start seeing supply coming out, and in the next 45 days. You could see a lot of supply hitting the market. But equally, like I said in the beginning, we do have global investors as well as local investors who are eyeing the market, looking for stock-specific opportunities where there might be a little bit of a discount. And remember, a lot of these global investors also worry about liquidity, because if they're buying, let's say $20 million, $50 million, $100 million of a stock, it straight away tends to have an impact on the stock price. The price shoots up. So when you get a block, that's an opportunity for them to deploy capital. So to that extent, we think a lot of these activities will go through. We at Kotak are definitely seeing a lot of inquiries, a lot of activity on our side. We think it's going to be quite a busy next 40, 45 days. So let's see how things pan out. But overall, I don't see the market still correcting too much because of this paper supply, because the underlying demand is still out there.
Okay, all right, Pratik, appreciate you stopping by and filling us in with your take on the market. So maybe a little bit boring on the headline, maybe a 4-5% move either which direction, but plenty to talk about with regard to the broader markets. Look forward to chatting up with you rather soon. For the time being.